here's the answer to the quiz question. An oversold market is one which has potential to go up because the selling has quite literally been overdone. So the answer was option C, and I hope you all got it right. All right, coming back to volume indicators. Now, they also help us figure out signs of impending weakness and impending strength in stocks through signals of accumulation and distribution. That's something that we watch out for when you're seeing a little bit of sideways movement. Let's start very quickly with distribution. What this means is that basically the stock is getting distributed among many buyers. It's characterized by days when volumes are higher than previous days and price rise is a little weaker, and better yet would be if the prices actually close below the previous day's close. So if you see slightly weak price action on volumes, you know that the stock is getting distributed across many stakeholders. So this is not necessarily the case. Still, it's important to keep this at the back of your mind when you're analyzing charts, because accumulation and distribution are very elusive on charts. Sometimes you can figure them out. Sometimes you find that it's difficult to figure it out. But really, if you're looking at price action on a chart, where do you see this stock?
See, I think price action on the chart has to be combined, or rather the other way around. The volume action has to be combined with price action. I see volume in a way that you have to sort of differentiate it from selling, which is to try and take some profits on an existing position, and a type of selling where you're actually wanting to exit from the stock. Selling to exit or buying to own, which would be the other side of it, are more significant than the volume which is generated out of trades where you're just taking profits. When you sell to exit or when you buy to own, it's actually the action of larger players at work, particularly institutional players. Taking profit, the volume associated with taking profit is largely smaller traders. Okay, here's the chart of INFOSYS, and this is the day of results. And what you see here is a very long range bar, and then you see a very large amount of volume which has suddenly shown up on the chart. See the earlier volume bars, they're all very small and very normal, and this is all normal ranges of price. When you see big ranges and big volumes, this is clearly big boys at work, and this is the time when somebody is actually selling to exit from the stock. Typically, when this happens, the prices will go lower, and they will also find it very difficult to come up from it. Let me also show you an example of another stock where you're looking to sort of own the share. This is in the case of a more recent listing, which is called Lovable Lingerie. And in the case of Lovable Lingerie, you see that it had got listed, had the small uptrend. Then the stock went into a sideways phase when most of the holders probably from the issue, they all exited. And then you see that the volumes had really petered out here. You can hardly see the volume bars. Then fresh buyers come in. Now you see the big ranges. And this is not intraday chart, mind you. This is the end of day chart. And you have these long ranges in bar in the prices, and you have very large volumes which are going into it. This is something which I call as buying to own. Buying to own is a situation where larger players, particularly institutional players, are at work, and these are the critical things to note, whether people are buying to own it, or they are selling it to just take profits, or they are selling it to exit. This will set a trend, and trend is what we must really track and try to follow.
We spoke a little bit about distribution. Let's come to accumulation now. And generally, this is characterized by days of slightly positive price action on heavier volumes than previous days. So basically, it indicates that every time a seller comes onto the market, the price is being maintained by a steady buyer. Somebody is coming in there and steadily accumulating the stock, and this helps to make a strong base. And when you have a strong base, Dr. Narayan, it sets up the chart very well for a strong price rise after that, right?
Yes, indeed. Let's illustrate that scenario about accumulation using a chart of BIOCON weekly. Now, I'm actually going to cut to the 2008-9 low, which is where the stock actually showed some signs of accumulation. Now, here is the stock which has actually dropped, and you're seeing the low volumes there, which is very, fairly typical when it starts making a low. Now, it starts making a higher bottom, and post the higher bottom, there is a breakout. So, this is the first of the higher top, higher bottom price pattern. Now, whenever the stock makes an accumulation, it will also do so in trying to form some sort of a pattern. It may be a pattern of higher top, higher bottoms. It may be a pattern in the classical sense of a head and shoulder inverted rounding pattern, etc., which we will discuss later. But here you have a higher top, higher bottom formation, and then just take a look at this increase in volume as the prices start to move up. It's not so far away from the bottom, right? But then look at the surge in the volume. This is what you will typically see as accumulation volume. And when you spot this, particularly on a weekly chart like the one I am showing you, it's a clear signal from the market that you should go into this stock as an investor.
Right. Accumulation there, it's always a good sign because it sets up the stock for a sharp rise, and that's because the stock has come from weak hands into strong hands, and by strong hands we mean buyers who will have long holding power, who believe in the long-term story of the stock and will not sell at the first sign of weakness. So that's how the volume pattern adds up in accumulation and distribution. All right, moving on, we've got a good understanding of volume indicators. Let's look at an analysis of last week's chart quiz, but we'll do that with Dr. Narayan right after this break.